Hello? Yes. No, you have to go to the one on the morning at 10 a.m. I don't know that they know that, but I guess they did not send the notification with the link again. It's the same notification that was before. Okay.
I think the one at 10.
Yeah. Yeah. Folks are starting to come in. Okay. Thanks. Bye bye. Jamie.
Yes, sir.
He's muted.
The notification. Can you send me the link again? I don't know if everybody was able to go to the original notification, because I know Mr. Colbert has the one at 10 a.m. and he needs to look at the one at 2 p.m.
Okay. Can you stop sharing your screen for a moment? Okay. In the upper left-hand corner, there's a little exclamation mark and it says meeting information. If you click on that, it's going to show you the meeting information, and there's something that says copy link, and there's where you can copy the meeting information so you can email it to whoever you'd like. Do you want me to email it, or would you like to do it?
I have it. Okay, thank you.
Yes, sir. And I'm going to mute again, but let me know if you need anything else.
Why is it asking me for that?
So was it that we were rescheduled this morning from 10 to 2?
Yes, it was posted originally for 10, and then the meeting was set at 10, but it was rescheduled for 2 p.m. and the link was sent out. But I don't know that everybody received this particular link, so I'm trying to resend it right now again.
I don't think the link changed, Jesus, from 10 to 2.
Yeah, no, it didn't change. It's just I think in the invite it was not included. You have to go back to the one at 10 a.m.
It was included as an attachment, like it was in the attachment, and I had to follow through that. It's fine.
Actually erased the 10 o'clock meeting, which had the link. And so I had the 2 o'clock meeting that didn't have the link. So I had to go back and find the previous email or invite. How's everybody doing? Hi, Amy.
Hey, how's it going?
Mm-hmm. The thunder has been shaking my house out in
Yes.
I mean, it's torrential.
Yes.
I lost power today.
If you hear it shake up, it's because I'm right next to the door, and you can hear the vibration from the thunder.
Well, I'm hoping to keep a good connection because this morning my connection was terrible. So we'll see what happens.
Yeah, you sound like you're breaking up a little bit.
Yeah.
Sarah, do you have the board members' emails? If you could resend, I'm gonna send it to you and forward in case they don't get the email. I don't think I have a template for everybody, so let me just send it to you real quick.
Sure.
Just forward it.
Okay. On the committee though is, for feasibility, is Mr. Cantu is chairman, and then Mr. Norris and Ms. Hinojosa are official committee members. Of course, any board member is invited to attend, but just so we are clear of who the actual committee members are.
Looks like everybody's here, Jesus.
Buddy?
Mr. Cantu, since you're the chairman of the committee, would you like to call the meeting to order, please?
Oh, yes. It's 2:05 on my clock here. Sorry for my tardiness. We'll call this meeting to order.
Thank you, Mr. Cantu. How does everyone hear me? Am I choppy?
A little bit.
Very little.
I don't know. I don't know if I should speak slower or louder. That would help. The purpose of today's feasibility meeting is to discuss some facility upgrades that we've been looking at for some time. I have coined this Operation Facelift for Harris County Department of Ed. And there are a number of facilities that need some desperate attention, and I'm going to just briefly talk about why it's probably the perfect time to address them. The first thing that I will tell you is inside your notebook, you got a program requirements document from a company called LAN that did basically a needs assessment for us, but we will also enlist in their services to do project management for most of these projects. I was able to solidify their assistance in the needs assessment well under $50,000. So we were able to complete that without getting board approval, just so you know. But this is what they do for a living, and they're excellent at it. The four facilities that we're looking at is our adult ed administration building and academic building. You know, this is a building that is the administration building. We've had to actually evacuate everybody out of that building because it has a number of safety issues and health issues. But it's a facility that desperately needs to be upgraded. We're within the adult ed building. We're also looking at their academic facility, doing just a refresh of that building because it desperately needs it. We have leaks in the ceiling. We have a tremendous amount of parking issues where we find that adult learners are parking in front of people's houses because they can't get access to the building. We are woefully short of parking when it comes to that facility. The second facility is our ABS East campus. As you know, we just built a brand new building for our West campus. But with ABS East, we actually own 10 acres of property behind that school. And so we were faced with the dilemma to either refresh that building or to build a new building, almost exactly like our AB West building on the property that we already own, but we've not made any use of it whatsoever. The analogy that I use with our ABS East campus and really the adult ed building, they're kind of like a car that's got 350,000 miles on it. And you're wondering whether you really want to spend $2,000 on tires or just buy a new car. And so we're at that point with those two facilities that we've gotten about all the usage we can get out of it. And it doesn't make good business sense to continue to pour in six-figure, sometimes seven-figure dollar amounts to be able to keep those facilities up to standard. The third facility that we're looking at is our High Point East, which is basically our alternative school for students who get expelled. We have two separate schools in that location, where one is the high school, the other is the middle school. The high school is in exceptional condition. It looks excellent. And our maintenance and facility crew do an excellent job with that. However, the middle school is actually an old church that's been converted into a school. We have some ADA compliance issues. Example, there's no elevator in the building. So if you were in a wheelchair and the kid needed to be on the second floor, we would have to bring that entire classroom downstairs because we're not in compliance. The building has almost no windows in it. The hallways are too small. We have major drainage and leakage issues with that. And so we could easily, to bring that facility up to speed, spend several hundreds of thousands of dollars, whereas we could just look at building anew and get a facility that's consistent with the kind of services we provide. And then finally, the fourth facility is the Irvington Administration Building. This is a building that I believe, Rich, is 24, 25, 26 years old, has not been refreshed since its inception. And it has evolved into something other than what it was designed to be. And so the best example I can give of that is back when this building was built, Harris County Department of Ed probably had at best 500 employees, probably not even that many, maybe a couple hundred employees. Since then, we are probably, 2 to 3 times larger than what we were back then. And the building's got the square footage, but it doesn't have the infrastructure to house our current people that we have at the administration building. Some of the outward examples of that is storage. We lack a tremendous amount of storage capacity, especially for our Head Start campuses and our school campuses. When we need to put together materials for our students, there's no place to put it. So we've had people using hallways for storage. If you go throughout the Irvington building, you will find cubicles everywhere, even in hallways, because they weren't designed for people to have offices there. There's more people than it was designed for. So that's something that we're also looking at. And then there's also some safety issues that need to be upgraded there too. Now, the reasons why we're doing this now, and I'm about to turn it over to Dr. Amesqua, there's really 4 factors. And 2 of the factors are good factors, and 2 of the factors are really bad factors. Let me do the bad ones first. The first bad factor for why we need to get into this now is because, like I said before, our facilities are aged. Our adult ed building, I would probably say the High Point facility should have actually been addressed years ago. Years ago, we should have never have even allowed to get to this point to where we're really having to give it some attention, but they should have been addressed many years ago, but we've been basically putting Band-Aids on the facilities, trying to make do. The other bad reason why we're in this position, or why we need to address these issues, is because I would say that our facilities aren't consistent with the quality of the program that exists within it. Let's take adult ed. We have the largest adult education program in the entire state of Texas. And I would say that we are probably a premier adult education program in the entire state. We educate over 8,000 adult learners every single year. But if anyone were to come to Houston to do a site visit to see what the epicenter of this, the best adult ed program looked like, it would be an embarrassment. Like ceiling tile falling down, a number of issues that need to be addressed. It just certainly wouldn't be consistent with the quality of program that we have. So those are the two of the negative factors that cause us to call this meeting and do a feasibility study. The two good reasons why we should do it is because we have a super healthy fund balance. We have money in fund balance that, because of good business practices, because of discipline by our board, and just, to be honest, being overly frugal, we have been able to accumulate money in our fund balance to the point where we need to spend some of it. Our fund balance is getting disproportionately too large for the size of our organization. And so all the articles I've read say the best businesses in the world are the ones who invest back into the business. And so if we were ever going to spend it, I would want to spend it on something that's going to increase the perception and the quality of programs that we provide. So that's one of the good reasons why this is a perfect time. The other thing is that Dr. Mesquel talked to you a little bit about, we're about to lose some debt, which is a good thing. We're going to drop debt. We're going to pay off some bills that we've had where we won't have those bills anymore. And everything that he's going to talk to you about is how we can pull off this major operation facelift and still be able to make payments similar to that we've been making for years. You know, it would be the equivalent of paying off a house, and instead of just, you know, saving and stockpiling more money into a savings, let's purchase another house and have the exact same mortgage that we had previously. The final reason why I think it's a good time for us to be considering this is interest rates. They are low. They're really low. And if there was ever a time to do something where we were going to, you know, take on some debt, we'd want to do it when the interest rates are extremely low. And so for those reasons is why we called this feasibility meeting. Dr. Mesquel, I'll turn it over to you so you can take them through the nuts and bolts of what the implications are for the budget. And I think it's timely that we look at this now in this meeting, so when we get to our budget workshop, we're going to be able to reference it when we go over the entire general budget. Dr. Mesquel.
Thank you. Good afternoon. Before we get started and I switch screens, I want to make sure that everybody has the same packages. We have the package that we mailed to you, and also it should have included the program requirements. I believe there might be, I might have left out one of them, so I don't know, Mr. Cantu, were you able to receive it electronically, the file?
Yeah, mine wasn't in the binder, but I did just see it on the email.
Okay. So hopefully everybody else received it. I tried to put all the packages together, and I might have missed and picked up one that I didn't have the program requirements. We also have in your packet, try to make this a little bit interactive. I try to include a pocket like this, kind of like a wallet. And so I'm going to use a little bit of the theme of, I don't know if have you seen the Capital One commercial on Bank Reimagine, where it says, what's in your wallet? Well, imagine this is your wallet, and I have included in there some questions that are in a card, that are in a index card, and they're numbered from 1 through 20. So when we have some pauses, I'll ask and see if you have some questions, and there may be some in that pocket there, that some suggested questions that that you may want to ask in terms of, you know, where we're at in the presentation. Before we again, when we get started, let me share my screen, and let me look at the first the program requirements. Can everybody see my screen?
Not yet.
Oh, sorry. Sorry. How about now? Okay, so this is the document. Let me just briefly just go through this document, and then I will go through the PowerPoint presentation. On page 1 of, well, actually it's page 2 of the document, you see the summary of project budget estimates by the major projects. Now, the phases that this report has, it's a little bit different because we identified them as different phases. They included their phase 1 and phase 2, but when we talk about phase 1, it's really the entire project, which is 51.5 million. Phase 2 is for 2 other projects that are not being proposed here, and then that they will be for the future. And so in each one of the documents, there is a summary. For example, it says adult debt phase 1, new building, parking garage, 17,558,750. There is a detail regarding that. If you go to page 5 of the document, we look at what does that make up, and basically is the building, the site development, demolition, parking garage. And so each one of those includes an estimate by project, and so the details embedded into this particular report as a total. For me, the big takeaway in going into my other presentation is to look at the overall and the total, where we're at the 51,546,770. And that number I will be revisiting in my presentation and looking at some adjustments that we had to make and some changes made to this particular report. So now I'm going to switch to the PowerPoint. And in this PowerPoint, we're going to talk about primarily into 5 major areas. We're going to talk about the 4 big projects. We're going to talk about the ability to issue debt, the capacity, the financial condition. We're going to talk about the structure. We're going to talk about, you know, the PFC, the maintenance notes, and bonds, and the difference between those two in that structure. We'll talk about the market, the municipal market and the treasury market, and how they have been impacted right now by COVID-19. And lastly, we're going to talk about the implementation and the process going forward with this project. The department always, this is our overall major programs: adult education, our after-school program, Head Start, and special schools. And this formed the basis for why we're able to fund and be able to enter the bond market. Because we do not have an interest and sinking rate, we rely on contracts with school districts in order to leverage our local revenues and bring in some money from the market. And I say the market, I mean the bond market. Without that, we will not be able to access the bond market and will not be able to sell bonds. So for example, if you were to go to the bank individually and you ask for a loan, they ask you, well, what are you going to guarantee in order to borrow a loan? Cities, counties, school districts, normally what they do is they say, I have a tax base and an interest and sinking tax base, and so I'm able to leverage it that way. Well, we don't have that one. And so in order to do that, we have to leverage it from our contracts, which is our special school contracts, our grants, and any other revenue that we have locally. So in order for us to even begin to look at and moving forward is, well, what is the HCD's financial condition and as of May 31st, 2020? We just went over this report last month. And so I'm just it's gonna seem a little repetitious because we just had the board meeting and I presented this information to you. We have some excellent cash flow, and let me just show you that we have $40,648,242 in cash, in securities, which is basically overnight. We have excellent equity. As of May 31st, we have $42,136,758, and we have an excess of $10 million in terms of revenues versus expenses as of May 31st, as of during the period of time. So that 10 million is going to be used between now and August the 31st. So we're in a hybrid model. Yes.
Are we supposed to be following along? Are you on your screen or?
You can, or you have the presentation or a copy of the report also. Either way, it's fine.
I'm trying to follow along, but I don't see it on the screen. So it's in our book instead?
Oh, I'm sorry. How about now?
Oh, okay.
Okay, I'm sorry, because I have both of the items open, so you probably were seeing the program requirements report.
Yeah.
So sorry about that. So this is just the first 5 pages. Let me go back to, here's the agenda, what we talked about, that these are the 5 things that we're gonna cover today. The need for the projects, the ability to issue debt, the structure, the market, and the treasury market, and then the implementation process. And as I was mentioning, is be able to afford and be able to enter the market. We rely on our contracts with school districts in order to guarantee the repayment of the bonds. Bonds that we issue are typically 2 types, either they're maintenance notes or they are revenue financing notes. And so in order to enter the bond market for revenue financing notes, revenue producing notes, then we need to be able to have enough contracts to be able to guarantee the payment. So it's like going to the bank. You go to the bank and they ask you, well, what is your collateral? What is it? What revenues do you have that are gonna make the bank, feel like you're gonna be able to afford a particular loan? So the first thing that they ask us is, what is your financial condition? What is your assets, liabilities, and so on? So here's where we're at right now. Let me move you a little bit to the side. So we have excellent cash flow. We have cash for a little bit over 40.6 million. We have good equity of about 42.1 million. And we have about approximately 10 million excess between revenues and expenses just for this year alone that we're gonna end up the year in a positive note. We have low liabilities. Right now, we only have 2 million of current liabilities. We have a positive business model, and we're ahead in terms of our revenues as of this time, as of May. Again, this is on a month-to-month basis, so we continue to monitor each month, and every month we provide a monthly financial report of where we're at. And this is our balance sheet that we would present to the bond market so they can see our strength in terms of our balance sheet. Here's our customer fees. We're at 19.7 million. We've collected, and you see all the percentages that are above 100%, that the major 5, which include special schools, therapy services, records management, and choice, they're all ahead as of right now. And so still 3 months into the year, we're looking like we're going to be receiving the majority of our revenues, even though we're still on a crisis even right now. So the top 5 tax revenues, we've collected 95% of our levy. We still have approximately 881,000 left to collect. We generally expect approximately 300,000 right now. So we will see here in the next few months whether we're still going to be able to collect that extra $500,000 in taxes. We have special schools contract fees. We have billed over 101%. We have AV West, we billed over 83%. Fortis has billed 140%. High Point East, 98%. Therapy, 88%. Records Managed, 61%. And Choice Partners, it's at 113% so far as of May of this year. So it's about $300,000 above the budget just for this year alone. You also have certain divisions that and how are they doing in terms of budget to actual. So Choice Partners is at 2.5 million profitability variance. Records Management, we're still going to collect 152,000 for the rest of the year. We have schools at 498,000 and educator certification at 398,000. All those revenues will come in later on in the fall and the spring. So in terms of our financial condition, if you look at your cards, and are there any questions that you may have so far before we move on to the next section? Any questions from anybody? Okay. All right. Then let me go then to our next section, which is our fund balance. And one of the questions is, what is our fund balance right now? We're at 32,614,360. We're projecting that we're going to look at utilizing some of that fund balance to be able to pay some of our current debt, and then be able to issue some new debt and be able to continue to pay our debt and continue into fiscal year 20 and 21. Some of the projects for this year that are included in the capital program include several projects, and there's 4 that are included in the needs assessment. The first one is AB East, and this is to complement AB West. AB East has exceeded their capacity and the facility is needed. It's approximately a 40,000 square foot facility. The next one is High Point East Campus. This is to provide a facility for middle school students. The facility needed is 13,750 square feet. The next one is a new adult ed center for adult ed classes and workforce development facility, which is approximately 40,500 square foot facility. The fourth one is remodeling of urban building over 60,000 square feet to modernize and reimagine HCDE. And so here's the breakdown of the program. On the left-hand side, you will see, try to minimize this, you will see the square footage and also each of the projects, and the total amount for the land report is 51,546,770. We reduced some contingency in order to be able to make the numbers work. We felt that there were some adjustments to those numbers that needed to be reduced, and so the revised number is 50,346,770. And then we also added a playground for AB East because AB West had a playground that was added during construction, and so the total amount that we would look at financing would be 50,946,770. Now the breakdown of that is that we're going to look at a PFC bond, a revenue bond of 30,581,882. We're looking at utilizing 5 million from our fund balance, 5,740,000. We're looking at utilizing interest earnings of approximately 251,888, and then maintenance notes of 14,373,000 to round up the total bond package of 50,946,770. This one page pretty much tells you the entire project and the financing, and the presentation reflects all the details that are included in this one page. There's also a phase 2 to be funded in the future, and that's the workforce development for 3 million and equine therapy for 1.5 million. We currently have 32,614,360 in fund balance, and so after the implementation of the program, we'll end up having approximately almost $19 million in fund balance for the organization, which is within the best practices percentage for governments similar to our size. On phase 2, as I mentioned, that includes workforce development program from adult education program, $3 million, equine therapy, 1.5 million program. Again, the scope and funding to be determined into the future. Looking forward to our annual budget into the new year, we're looking at incorporating this bond program into the FY21 budget. And looking at that, we will have a need to make some transfers to the debt service program, debt service fund, and also the capital projects fund. Before I go into the market, any questions that you may have regarding the program, the projected financing, and the needs that we have presented so far?
Dr. Amezcua, just real quick, touch again on how important it is to bring our fund balance into a reasonable range, and we need to spend the money and spend it on something. Yeah,
well, fund balance, we need to maintain it anywhere between 25 and 30% of our operating expenses. That's a good, healthy fund balance. We have more than that at this point in time. And when we spend fund balances, it is always good to spend it on one-time expenditures that are only going to be one time and not going to be recurring. So things like equipment, buildings, things that you acquire and then spend them, and then they don't recur the following year. And so this is a prime candidate to be able to utilize our fund balance and leverage it in order to enter the market and make it work. When we talk about the market, and when we go to the Standard & Poor's and Moody's that are going to be looking at our bonds, it'll be very important for us to show them how we're going to utilize the fund balance in order to be able to afford this particular bond program. And I'm going to address that a little bit later in the presentation as we move forward in that. Any questions in addition to that I can follow up before I go into the market?
Yes.
Yes, sir.
On page 17, you have a yellow column called revised PFC, and then one on the very end that's sort of a light green.
Yes.
And it's tax notes. What are the difference between those two funds?
The PFC and the maintenance notes?
Yes.
Okay. So the PFC, it's a revenue bond, which will be issued through the PFC. It will be backed by local contracts. It will be backed for any revenue that the organization generates. For example, contract with HISD, contract with all the school districts and so on. That's the revenue that is guaranteeing the repayment of the bonds. So it's kind of like our current PFC bonds that we have for AV West, that the contracts for AV West help to borrow that so that you can pay for those bonds. Now the maintenance notes, those are tax-based. Those are guaranteed by the local tax base from the organization, which means it can only generate maintenance and operation tax from the organization to pay for those. So the local tax base will guarantee that. Now, at the end of the day, once the organization, let's say that we did not have any contracts, well, you have to look at one or two things. One, do you use taxes to be able to supplement, or do you have to sell the property in order to liquidate and be able to pay off the debt? Which we hope that we'll never have to do that. So, but that's the difference between those
They're
two.
both bonds,
They're both bonds.
both revenue bonds. One's contract-based and the other one's tax-based.
That's correct. That's correct. Now
And
there's
is
also a
the
difference. I'm sorry. Go ahead.
is the process of issuing those bonds the same?
It is very, it's almost like 99.9% the same,
Okay.
with about 2 or 3 differences. And I'm going to go through those when we go through the financing and the structure as to the
Okay.
difference between those two. Thank you for that question. I think that's a very important point to look at the difference between those two, and I'm going to address that when we get to the structure in the later on in the presentation as well. Okay, so yes.
And we may need to hold off the answers to these until the end of the presentation, but I
That's
just
okay.
wanted to quickly. The first thing is, do we have a renovation plan comparison for each one of these proposals? That's the first thing. And these are in 2 phases. We have phase 1 and phase 2. Phase 1 being the bulk of the money.
Mhm.
So are we planning to approve these in a tiered approach?
Yes.
That would be, that's my next question. And then I would like, and this is, the equine therapy isn't until the 2nd phase, so we can probably wait a little bit on this, but I'd like to have some more details on the equine therapy and the attributes of it and how it will help our student population.
Okay.
And then what kind of deadline do we have to spend our fund balance? And so those are my initial questions right now.
Okay.
And yeah, so that's it for now. I'll wait.
Okay. Let me ask you, the first question you mentioned, a renovation plan comparison. Let me ask a little bit more about that. When you mean comparison, you mean RFPs and bids and things of that nature?
I mean, if we're proposing building a new building, what is the comparison with renovating the building instead? Because what I heard was if we renovate the building, it could be 6 to 7 figure renovation, at which point it doesn't make sense to renovate the building. We should just build a new building. And so I'm asking for details on that comparison between building a new building as opposed to renovating. And then more details on what is it. I know that there were some leaks mentioned. For High Point, the halls are too small and the elevators there's no elevator. So I know that there were some things mentioned at the beginning of this meeting, but I would just look for more details on specifically for each proposal for each of the facilities. What is lacking? And then again, just a comparison between what if we went forward and did a renovation instead, and how does that compare with building a new building?
Okay. Let me address one of them. There's 4 projects. The one for administrative building, that is like strictly a renovation. There's not a new building entertained on that one.
Right.
So really the only comparisons will be the first 3. The first one, let me just, and I'll follow up with more detail, but just so I can answer the question is, we looked at AB East, and initially the engineer that prepared the report brought a plan to renovate the building. And that building was going to be roughly almost $17 million as well, to renovate. Now, when looking at the renovation, we also need to look at, but where the students are going to go while the renovation is going on. That's another cost that we have to entertain in order to do that. So the cost of the new renovation for AB East versus the new building for ABEs, knowing that we already have a land at AB East, was very minimal in terms of versus one versus the other. We will follow up with the details so you can be able to see the comparison between both of them. But basically, that's the comparison that we had to go through in order to determine that it was going to be a new building versus a renovation. Now, that also comes into play in terms of the types of financing, and I'll go later on into a structure because Mr. Cantu mentioned about what is the difference between a PFC and a maintenance note. Well, one of the other differences is that the PFC, you can build new, you can renovate, and so that's a little bit more expensive. It's more expensive to build through a PFC than through a maintenance note. Now, a maintenance note is eligible only for renovation, so it would behoove us to do more renovations than PFC. However, in the long run, it would cost us more to do the renovation because eventually you're going to have a new building. So we'll provide that comparison on both of those. And the other three, I think I'll get to the last part before we get to that. Yes, sir.
And that's an excellent question, Ms. Hinojosa. And they actually LAN provided us with that. To Dr. Mescal's point, Rich, just be sure that we follow up and get the previous report on how much renovations would have cost versus new construction. And so we can break that down to what it would look like just for the construction costs of renovating versus building new. I think we need to also break it down to financing and how that would help us, the difference it would mean between building new and financing. You know, and then also the other consideration that always comes up when we have these discussions about renovating or building new is, do you really, and this is what I struggled with, is do I really want to put several $1 million into a 20-year-old building, or use this as an opportunity to pivot and build a new building? And I'm sure those are things that you would want to be able to look at too. So we can get that, and we'll follow up with that this week and make sure that everybody on this call gets that. But Rich, I need your help with that, so give me a thumbs up if you hear me. All right, go ahead, Dr. Mescal.
Okay.
Dr. Mescal, one more question,
Yes,
just to piggyback off of Trustee Hinojosa's question about renovations. Would these bonds even cover a renovation, or if we get bonds, is it exclusively can it only be used for new construction?
Yes, maintenance notes can only be used for equipment and renovations. You can only build around the footprint of the building for a maintenance note. So now so if you wanted to have a new building, you'd have to do it under the PFC. The PFC is a little more expensive because it's a real estate transaction. In essence, we're going to sell bonds, and the guarantee is more expensive because the market perceives that to be more of a risk than a maintenance note. Because the maintenance note has the full faith and credit of the local government, meaning the tax base. Therefore, it's more expensive to do a PFC than to do a maintenance note. Okay, let me now going to, all right, the market. And please bear with me a little bit with the market because this is an unusual market. It sometimes does not behave in the way it's supposed to. And so I'm going to talk a lot about the capacity and how the market has come to be in, and a lot of issues of supply and demand in terms of bonds and what's been in the market and where we're at today because of COVID-19. So one of the things that when we're looking at balancing the COVID-19 in the financial market is, first of all, there's been some disruption into the markets. The market and the bond and the stock market for a while was holding off to not being participants in the market, not having enough supply and demand for bonds. And then there was a policymakers response where they have come in and incorporated several monetary policy into the market that have changed the trajectory of where the interest rates are and the available demand and supply of these types of bonds into the market. So we're going to navigate through that market and see how that affects us and how we'll be able to enter that market given who we are and given the perception of us in the market as we stand today. So our yield curve, a traditional yield curve, it is upward sloping, meaning it's like a check mark. The longer you go out into the market, the higher interest rate that you're going to have to pay. Traditionally, that has been the type of market that the municipal market and the treasury market is, because you know, being the loss of supply and demand, you know, the longer you go, then of course there's more risk involved. So we have to take a look at how supply and demand has impacted a commodity, just like any other commodity in the market, whether it's oil and gas, whether it's agriculture, whether it's commodity goods, or even bonds. How does that come up? And so what we're going to look at is, and the issues of demand is, you know, when there's a lot of demand, you would think, well, that means that the prices are going to go up. And if there's a lot of supply, that means the prices are going to go down. That's normally into the market. However, the federal government through monetary policy has come in and changed and altered that, because of the market and the supply has been altered, and therefore you will see how the treasuries have been impacted. In this particular slide, you see some of the bonds that have gone into the market recently. The Texas Department of Housing sold 175 million in bonds. Del Mar District, you know, some Fort Bend County, Stephenville ISD, about 643 million went into the market here in the last month or so. And so they were successful. They had low interest rates, but typically the bond market is usually about a $13 billion market in Texas. There's school districts, cities, and counties that sell bonds, and so there's a lot of liquidity in the market, and so therefore there's always enough supply in terms of these types of products. However, just because there's supply, does that mean that there is demand for it? And so in order to look at that, let's look at what has happened the last 3 times that interest rates have gone down. And this is a chart that goes back to the Treasury and the money market for bonds that are 30 years. And as you can see, the green line is usually above the blue line. What that means is treasuries are generally less expensive than local markets or the municipal markets. And therefore, they trade higher than treasuries. Well, there's been 3 times in this particular market that it has been the other way around. If you go back to 2009, there was the housing bubble. The interest rates were cut by 225 basis points. The federal government came in and reduced monetary policy and reduced rates by 225 basis points. Unemployment was at an all-time high at that time at 9%. There was a swine flu and the AIG was about to collapse. And the housing basically, you know, was created where everybody always seems that your market value of your house is always goes up. Well, in 2008, 2009, we did not see that. In fact, we saw a decline in that. And that caused the market to create an unusual situation, and therefore the treasuries were below the markets at that time. Then move on to 2013, there was a lot of discussion about the shutdown of the federal government, the debt ceiling. Everybody was fighting about sequestering funds for schools and local governments. So the Fed continued to buy long-term treasuries to maintain liquidity into the market. They kept on buying so that people can continue to borrow money. And so they had to bail out by buying more treasuries into the market, in other words, supplying more dollars into the market. And so when you supply more dollars into the market, rates go down, and therefore you're almost going to into zero interest rate. So moving on to 2020, COVID-19 hits. Fed right away reduces Fed funds to 150 basis points. They cut the bond buying as well. Therefore, these are three types in the history that the rates of municipal markets have been above treasuries. Now, what that means for us, that's a potential opportunity for us to enter the market and be able to secure some loans that are positive for us and be able to get a good financing in the market. If you are a good credit and you're going to enter the market, you're going to get paid basically as the market does. But if you don't have as good a credit rating, then you're going to pay about 15 to 30 basis points above those rates. We are right now considered a AA2 or AA by Standard & Poor's. And so we're hoping to go before S&P and Moody's and get a rating for our bonds so that they can rate us and be able to go into the market and sell these bonds. Here's another security or another slide that deals with the treasuries and municipals. Municipals, if you look at the chart, basically we're in the 2% range before COVID on January the 20th. And then after COVID, they are roughly about 150. And in terms of the 30-year bond, it is at 1% versus at almost a little under 0.50. What this basically shows is that HCD borrows generally between 20 and 25 years for our bonds, for our long-term bonds. Last time we were in the market, the PSV for AB West, we went to the market for a 10-year bond, not a 20-year bond. So we're basically changing the market and adding, going to a much larger market. So I guess for me to basically tell you is, do not expect a low interest rate from a 10-year perspective. Expect a low interest rate from a 20 to 25-year perspective, because we're going to extend our borrowing capacity. We're going to extend our number of years that we're going to go into the market. Interest rates are lower than 0.50. We usually invest in 30 days and under 1 year. So we have no motivation to extend beyond 30 days because in order to pick up 10 basis points, we have to go almost 30 years, beyond 30 years. And at this point in time, it doesn't behoove us to do that. So we're keeping everything in short-term instruments that are basically below 6 months, usually in the 30-day horizon. So the policymakers that responds to this COVID-19 has been rate cuts of 150 basis points. They provided liquidity, buying and asking of assets in the market to be able to allow markets like ourselves to be able to enter the market, and there'll be enough liquidity so that the continuation of financing of projects continues for local governments just like ourselves. The stock also went down, and so usually there's an inverse relation between bonds and interest. If the stock goes up, interest rates for bonds go down. Again, this is an unusual situation, and you see the market all over the place. You see from one day to the next that they continue to change, and so the only thing that has maintained that relation is the fact that the federal government has come in and guaranteed through liquidity and loans to be able to stabilize the market and not allow it to go into a panic. And so federal monetary policy has been effective in order to be able to maintain some type of continuity into our markets. So the impact to our investments is that we've seen our investment go from 158 to approximately 0.39 in just about 3 months. That's a radical down on our investments. And I know Ms. Duhan asked that question during the board meeting. We're earning approximately about 0.30 basis points on our investments. And so we're keeping everything short term, so as hopefully those will climb back up, we'll be able to climb that. We do not want to extend, because that means more risk to the organization. So we don't want to extend it to 1 year or 2 years, because otherwise we'll be underwater and then we'll have some real losses in terms of our investments. Okay, so that was kind of a quick oversight of what the market looks like that we're going to be entering. I'd like to pause for a moment to see if there's any questions that you may have regarding the market, because this is a market, while it's good for debt, it is a market that we need to basically explain who we are so that we can get the right interest rate and the right investor to buy our bonds and be able to be ready for us to provide that to them. So any questions that you may have on what the market looks like right now?
Just real quick, Dr. Mesqua, you mentioned that a 10-year note would not bring about better rates compared to a 20 or 25-year note. So it's the opposite. It's the opposite than like a homeowner gets, because normally, term you get a better rate.
Right. Well, basically, right now, in order to get a 10-year or 20-year, the only thing you're going to get is different players. For example, banks usually buy notes that are 10 years. So you get a lot of banks that buy those notes. Once you get into 12, 15, and 20 years, then banks are not interested. Then you get another type of investor that is looking into the 20-year market or the 25-year market. Maybe a pension fund, maybe some investors that are looking to guarantee for long-term those rates. And so what I was trying to compare is when we did the PFC about 3 years ago, we had a 1.62 on those rates, but it was only a 10-year. And banks were just wanting to grab us right away. I mean, there were about 6 or 7 banks that were really wanting to get our debt because it was really good. And so they're in that market. Once we get into 20 to 25 years, we're not going to get a bank to get interested in us. We're going to have to figure out who else is out there that can provide that borrowing capacity for us. That is not a bank. It's probably going to be maybe those funds that invest in municipal exempt securities, and so they are able to go 20 to 25 years. Maybe insurance companies, folks like Capital One, like GE, that they buy those types of investments so that they can leverage their revenues with other types of investments. So it'll be a different type of investor that looks at us this time around. Normally we have a bio break. Mr. Colbert, do you want us to proceed or do we want to wait? Okay. So
I think we continue to proceed. I think people are taking their own bio breaks.
Okay. All right. All right. Let me go now into the structure. And I know, Mr. Cantu, you mentioned a little bit about, all right, so we have the capacity, we have the financial condition for us. The market, it looks like it's a market that we want to enter because it is prime for us to do that. Now, the question is, well, what's the structure? What does the structure looks like? Well, first of all, we don't have an interest and sinking rate, so we cannot borrow and have an interest and sinking rate. We only have an M&O rate, a maintenance and operation tax rate. So we have used all funds to pay debt that we have to come from either current revenues or local taxes. And so that gives us into 2 types of bond mechanisms. The first one is maintenance note. These are designed to be paid from local taxes, and they're used to purchase equipment, furniture, improvements to a building that's already been owned by us, and all we're going to do is basically stay on the structure or the footprint of the building. And so these maintenance notes are typically backed by local taxes, and so everybody wants this right away. If you go out into the market for a maintenance note, the market will say, okay, how much long do you need? You can go up to 20 years on the maintenance notes. You cannot go 21 years. You cannot go 25 years. The maximum amount on a maintenance note is 20 years. And that's intended by the legislature that it is a restriction on local governments to issue maintenance note no longer than 20 years. So in our projects, we have some equipment, even though we're going to build a new equipment. So for example, let's say we're going to build AB East. And part of that building is to equip it with new furniture, new equipment, a new HVAC system. All that will be eligible for the maintenance note. So we will put it on the maintenance note and we'll buy it from the maintenance note instead of the PFC. The PFC, it's a Public Facility Corporation revenue bonds. These ones you can go beyond 20 years, and typically this is kind of like what the school districts use to build their buildings. They usually go 25 to 30 years. Now we're recommending right now, in order to make our program work, we have to go 25 years on our bonds in order to be able to do that. And so we're going to have to commit some of our revenues, such as therapy, records management, special schools, to be able to guarantee those bonds, and that an investor, basically the way the investor looks at this, says, okay, what is the underlying credit, and are you able to cover the payment of the interest and sinking for those revenue bonds? And so they look at our contracts so that we can go ahead and provide that to the investor, and they can make a decision as to whether they want to invest in our bonds or not. So the first one is, we're going to look at 14,373,000 of maintenance note. The big one would be the Irvington building, which is all renovations, which is approximately 8.3 million. And then the rest will be for equipment, furniture, and capital needs for the other three projects that are embedded in those projects. And so here's an example of what the payment schedule will look like. Again, this is a draft based on more than likely scenario of what, if we were to go out and sell today, this is what it would look like. We would sell $12 million in bonds. It will be a rate of 4%. We would receive a premium, and the yield on those bonds would be between 1% and 2.1%. And the yield to maturity, it's going to be between 1.78 and 2.931 on after 2031. So basically, it is a very low interest rate for a maintenance note. Now, personally, I think that this is probably, it's on the high side. Once we go into the market, I think you're going to see a lot of competition. And so you're going to get a lot of takers that want to buy these bonds. And so that number is probably going to go down probably about, about 25 basis points, I suspect. And so keep in mind that we're not going to sell tomorrow or next month. We have to wait at least 60 days before we're able to sell bonds. So we still have a long ways to even look at what the market is going to do in 60 days. If we were to look at where we were 60 days ago, it would have been pre-COVID-19. And so 60 days from now, we'll have to wait and see where we're at 60 days from today. Next, we're going to look at a PFC. A PFC is basically a lease between the PFC, and the HCD, it does require a 60-day public notice. This notice has to be approved by the PFC and the Board of Trustees, and it's basically your opportunity to tell the folks in the county that says, okay, we're going to propose to sell this. And so basically they have to come back and do a public hearing and provide notice to the public that you are going to do that. It requires title to the property. It requires that the PFC and the HCD board approves, and this is what sometimes is called a double appropriation. It has to be appropriated by the PFC and also appropriated by the Board of Trustees. So here's the draft of what a bond schedule would look like if you were to sell a PFC bond. This is sort of like the payment schedule. If you were buying a house, this is a list of all your payments for all your scheduled payments for the next 25 years. Notice that the rate is also 4%. However, the yield to maturity is between 1.8 and 3.4, which is slightly higher than your maintenance note. Maintenance note is more like 2.7, so it's about 70 basis points different. And what that means is it's just a difference in the market and the difference in the type of structure and the difference in the risk for the investor. The next one is we're going to have 5.5 million, 740,000 plus 251,888 from fund balance and interest earnings to be able to round up the overall bond program. We have a total of basically 50,946,770 as a phase 1, and phase 2 will be 4.5 million. Now, phase 2, yes, it will be tiered, which basically you would only be entertaining phase 1 at this time. Phase 2 would be for maybe a year to 2 years from now, depending on the financing and the scope of those projects. Questions regarding the structure on the difference between a PFC bond and a maintenance note? Any questions that I can, before I go into the timeline? If there are no questions, then timeline is as follows. June is the Feasibility Committee review and presentation. Prepare for a board update. Feasibility Committee update in July. Approval and public notice approval. September, looking at negotiated sale. And then October, bond closing and start on the projects. The timeline, basically, and who are the participants. And this is a timeline from the bond counsel and financial advisor. There's a 60-day notice required. So from the time of that the board approves the notice, we have to count 60 days and then we cannot approve the bonds before the 60th day. So it has to be at least a 61-day. Participants will be the board, the PFC, will have to have a financial advisor, which currently is Louis Wilkes, bond counsel, Marcus Deeds, and then we'll have to identify some underwriters because we're going to look at probably a negotiated sale, which means that we'll have to get proposals from underwriters so that they'll be able to provide us with an understanding of what our credit looks like and be able to understand how we're financing this particular program. On approximately August 12th to 13th and about mid-August, we'll have conference meetings with our rating agencies, and they'll look at our credit and they'll issue a rating credit for us. And that rating credit will be very important to us, not just for this, but also so to provide to the market and to anybody that wants to know how our credit, how we're rated in the bond market. We look at a negotiated sale and potential closing on October 22nd. And so that would be a target. Now, though that day specifically probably be moved. It just depends on the timing of when the notice is made and we're able to enter the market. Now, sometimes you want to enter the market, and sometimes Monday is not as good as a Tuesday, depending on where the market, because the market, trades away, and so sometimes you have to be able to pull the trigger and be able to lock in rates and be able to go to the board for approval. Here's an important fact, and I want to show you the long-term picture for the financing for the department. What I want to focus on this particular, let me minimize this, and I'm going to try to go from left to right. So I'm going to start with on my left-hand side, it's the fiscal year. And next column is the taxable assessed valuation, 484 million. Well, we know that we're already at 505 million coming up for next year. So when we were talking about this, is that we were looking at the current valuation for this fiscal year. So just know that that number is going to go up to 505 million. Next, what are the interlocal contract revenues that are available? Well, we're going to commit approximately $14 million of our revenue towards these projects. And we have some outstanding debt, and our outstanding debt is included in 2014, 15, 16. So by 2026, we're going to be practically debt-free. So in 3 years, we're basically going to be under $2 million in debt. So what we've done, our debt currently, we pay approximately $3 million every year in debt. And that's the orange column on the right side. See where it says combined debt service? It's roughly $3 million throughout. In some cases, it is way less than $3 million. So what we wanted to do is, we wanted to buy a vehicle and be able to upgrade it, but keep the same payment. And so we have a total maximum rate of $3 million for 25 years. And we're gonna have to do that by doing a pay down on our current debt, which is the district contribution that's in blue. And basically we'll achieve that by being able to maintain our debt at $3,250,000 or less over the next 25 years, which is what we've been having here the last 20 years before. So it is doable. Notice that difference between the maintenance note and the PFC, the one in yellow versus the one in green. The one in yellow goes only to 20 years. The one in green goes to 25 years. So there's a difference there in terms of the length of the program. Any questions regarding this? This is a very important chart to understand the entire debt structure for the department. So you can see that there's not going to be a big balloon payment in any of the years. So therefore, we'll be able to continue for the next 25 years and be able to afford this particular program.
Dr. Amezcua or Mr. Colbert, if you have the answer. I know the phase 2 items are roughly what, like 3 million, something like that?
4.5.
4.5, yeah. Given that our combined payments are actually going to be going down over the next 20 years, that we're paying an average of 3 point,
except for the first 3 years.
Yeah, 2.5. We're paying 2.5. We're going to go up to 3.2 for 3 years, and then right under 3 for another 5 or so years, and then it's going to continue to go down. I'm just wondering if if it doesn't make sense to go ahead and roll in the 4.5 for phase 2 into this bond program so that we don't have to go back, especially since, the rates are what they are right now. Maybe there's a good reason why we're not doing it now, but I mean, I just, seems kind of obvious to me, but tell me why we're not rolling that little bit more into this.
Well, the biggest thing I'm concerned with phase 2 is there's still some flushing out that we need to do. As you know, equine therapy is something that we're looking at collaborating with Commissioner Garcia, who's supposed to be providing us property, and it's going to be a joint effort. But there's a tremendous amount of operating costs associated with that this bond wouldn't help us with. And I just kind of wanted to slow that project down so we don't get ahead of our skis on it. As far as the workforce development, there is a piece of property that I would like to go ahead and purchase that property as soon as possible while it's still available and fairly cheap. But we still need to do some fleshing out of exactly what that program is going to look like for the facility that we would ultimately get into. Everything that you said, Mr. Cantu, Dr. Amesqua has already posed that to me, that it might be cheaper to go ahead and stack that in up front instead of trying to get it later and we end up getting it at a different interest rate and not saving as much money. But that's something that we can certainly continue to look at, because I could always pick up my end to try to speed up and catch up with this whole thing, with the whole financing of it. Dr. Amesqua, is there anything you want to add to that?
Yes, those two projects primarily will be, the majority of those will probably be under the maintenance notes, and so there will probably be renovation. And so it'll be at a lower rate. Those, the maintenance notes, you can always do another maintenance note, a year from now and still be a very competitive rate, potentially, because it'll be backed by taxes and not a PFC. A PFC will probably be a little more expensive. But I think overall, we've gone through about 9, working with bond counsel and financial advisors, we've gone through 9, options, 9 changes in terms of, let's do 23 years, let's do 21 years, let's do only 10 million in notes, and let's do 40 million in PFC, to see that the right side stays as you see it there. There were several times that we had to, increase the debt payment by changing the combination between maintenance notes and PFC, and we feel like we come to a very optimal way to be able to achieve both sides. One, stay in the low interest rate, but also a low interest payment. Do not make sure that you have a PFC and also a maintenance note that would be received by the market positively, that there'll be a lot of investors that would want that structure. And so by doing a 20-year maintenance note, there'll be a lot of investors that will look at that. Now on the PFC side, we'll have to take a look at, what kind of pension funds and, other types of investors that may go a little bit longer, that are looking to invest in a revenue bond and be able to receive those kind of rates. Now, as you saw in the, let me go back for a second. The structure that we have is that we're going to offer a 4% interest rate into the market. What that means in today's environment, it allows us to get a premium. And therefore, our rate is not going to be 4%, it's going to be between 1.87 and 3.41 in terms of the rate range for this particular bond. What it does for the investor is that they'll receive a 4% interest rate in the future, and they'll have the ability to resell that bond down the road. And so it's more marketable for them at a 4% rate than, let's say, a 2 or a 3%. So the structure is also very important for the investor in order to be able to get it right and attract the right investors that can give us the best rate and also that it works well for them as well. Let me go
All right,
to.
we got a follow-up question.
Yes, sir.
I know, Mr. Colbert, you mentioned that you're still trying to, you know, sort of conduct the due diligence on that future project or program. Now, restrictions to going after bonds and not having a completely fleshed out, signed, sealed, and delivered program to spend it. In other words, if we say we're going to do equine therapy with some of this money and something happens in the development of the program and we decide it's not the best thing to do, does it jeopardize that funding that was earmarked for it? Do we lose it, or can it be reprogrammed?
Well, okay, let me, not having bond counsel here right now, but I'm gonna attempt to answer that. Based on my experience, is that you can use it for any of the eligible bond projects that you identified in the issuance. And so let's say that you wanted to spend more on Irvington building instead of Equine or AB East or any of those projects. As long as it's a renovation, if it's a maintenance project, that's fine. If it's a PFC, you have more leverage because that can be used for whether it's new or renovation. So you have a little bit more of a options under the PFC. Now I'd have to, since it's not a bond program per se, I want to say that there's no restriction from the state regarding the use other than what you send out the notice on its intent. So as long as you maintain it from one of those projects that are listed on there, then we will be fine. Now, if we decide that, let's say that $3 million get issued and only $1 million gets used for the other projects, and you have $2 million left. Well, if you don't use it, then you transfer it to debt service and you pay off your debt early.
Where my mind is already sort of leading is we go ahead and put that extra money in there, get the extra 4.5 million in bonds, and not that I don't want to do equine therapy, but let's just say that it doesn't go through for some reason. The money will already be there, and since we can use it for a building related expense, we can then reprogram that $4.5 million to build a second adult education building, maybe in Pasadena.
I think that's something that we can certainly look at. I mean, we see school districts do this all the time. They take out massive bonds, and within the 6 or 7 years it takes them to fulfill the bond, the plan may change and alter a little bit. Unfortunately, the way it typically happens is, they end up meeting all the needs of the original bond that they went out for, meaning that there's a school or something that doesn't get built. I'm curious, maybe this is what we need to do, Dr. Amezcua, is get Lewis Wilkes and them to show us the implications of how much money we might save if we were to roll this money into this bond package versus doing it separately. And y'all may have already talked to me a little bit about that.
I have talked to them about that, but the key thing is going to be is, are we going to do renovation or new projects? Because we have to know whether we're talking about 2.5% interest rate versus 3.5% in terms of the PFC. So I'll have to get a little bit more of the scope.
Yeah, well, we know with the adult ed facility that I'm looking at off of over there behind NAM, that would certainly be a renovation. There's no question about that. Right. The question would be, is the equine therapy, and I would need to get with Commissioner Garcia. He's got he's looking at 1 or 2 facilities, which are more so property than they are actually facilities.
Yeah.
To find out what category that would fit in and to pare down exactly where this program would be located if we move forward with that. That would not be that hard for us to do prior to going out for the bond. I mean, they have expressed repeated interest in wanting to make sure that we continue wanting to collaborate and partner with them because they desperately want us to do this equine therapy. And I just wanted to make sure it's in the best interest of our organization. Because I know it's in the best interest of his, especially when we're taking care of the operating costs. So I'm curious, get back with me on that. And then we can also get back to Mr. Cantu and other members of this committee and let them know what the implications of that are.
Okay.
All right, we're winding up. Dr. Meswell, we've been at it for almost an hour and a half. They're getting tired.
Okay. Okay, so the overall project in summary, 14.3 million in maintenance notes, 30.5 million in PFC, 5.7 general fund contribution to the project, 251,000 in interest earnings. The tentative
Real
implementation
quick,
is
Dr. Meswell, if we did this, so break down how that helps us with our fund balance. That brings our fund balance into a proportionate amount.
right. We will be ending approximately with $19 million in fund balance, which is for general fund, it's at least 3.5 months for our general fund. So still within the best practices from GFOA to maintain a good, healthy fund balance. And so this contribution is different than the payout of the principal and interest. So we're going to use fund balance for 2 things. One, to transfer to the debt service fund so we can pay down the current debt that we have. That's approximately $3 million. And then $5.7 million of project cost in order to be able to do the entire project. Now, when we go through a negotiated, this is the other thing that I wanted to mention. So let's say that we go through a negotiated sale, and the negotiated sale says, hey, interest rates came really down. We're going to end up at 2.1%. Well, now we have because it is a negotiated sale, we can go in and say, oh, can I add $4.5 million to the principal, since now the 2.5%, it is a lower interest rate. So we'll be able to have the flexibility to be able to do that at that time, should the interest rate even be lower than that. So October closing, July to September will be procurement. September will be project assignment. October, February to plan design and completion. March 21 through April, procurement of projects. May, and that number should say 2022. Rich, I did make that change. I just didn't make it on mine. May 21 to August 2022 would be the construction work, which would be about almost 18 months of that project. We also have operating costs associated with the project, so it'll be about 800,000 that we'll have to look at for 2022 once those projects get incorporated into our operations. What's next? Review of information, publish the notice, monitor the market, monitor the financial condition, approve the budget. We'll have a budget meeting here next Friday, and continue with the projects. Any questions or feedback that would you like me to? I know, Ms. Hinojosa, you mentioned about equine attributes, and there is no deadline for utilizing the fund balance. Fund balance, it is our cash and our money, so there is no requirement, legal requirement to utilize the fund balance since it's a HCD prerogative and not a market or a state requirement. Any questions or comments or anything that you'd like me to to provide any additional information on.
One last one for me. You mentioned we've already engaged a financial advisor and a bond counsel. Are those firms local firms?
We've had the same bond counsel and financial advisor. They're Houston firms, and we've had those for at least 15 years. They know our credit, they know our debt, and so they're familiar with what we've done, and so we feel very comfortable with having them on our side because they know our credit, and that's very important going into the market. Having somebody that knows our credit and be able to explain to others that we're a little bit of a hybrid local government that has some restrictions, but also can provide some of that revenue bonds and especially to those investors that we have to pretty much create a story in our brand about how to provide that to the bond market.
And are you comfortable with their rate? Is it a pretty competitive rate, you feel?
Oh, yes, they're always provided. There's a restriction on how much we allow them. We go through that negotiation every time we go through the bond requirement in terms of the percentage of the total. And so they built in for the last 3 times we've asked them to reduce fees, and they've been very receptive to us in the past.
I would just like to say that, this would be historic for HCDE. HCDE really hasn't done any massive refreshing or renovations in a long time, and we've been long overdue. Certainly with our AB West campus, I think it's state of the art. It's the only facility in Houston that was made from the ground up just for special needs students. And I think, this would be helping us in continuing to try to be in the forefront of some very specific initiatives that we do very well at, special ed and adult ed being 2 of them. Certainly our administration building needs to get refreshed. It's pretty bad, but it looks good for what we have, and our maintenance and facilities group has done a good job of keeping it clean and keeping it painted, and the floor is shiny. But ultimately, we got to do something about all these cubicles and hallways. And so I think there was some really good feedback in here. And then in Dr. Amesqua, I hope you've taken copious notes because we have some questions that we need to get back to. And
right.
Our goal is to be able to get something back to you by the end of the week for everybody on this phone call.
I have one more item that I wanted to show you. I know you have your handout, and in the back of your binder, there's a card that looks just like this. And this is just my way of summarizing everything that you have there. So if you can, there's a number 14 on the top left-hand corner of that handout. That 14 million means that's $14 million in maintenance notes. The 30 on the right side is $30 million in PFC. The 4% that you see on there means that it is a 4% coupon on the bonds that we're looking at. Then you see a 51 in the center, a 51. That's the total bond package that we're looking at. And then you see 2 numbers, 2.5 and 3.5. That is on the average. A 2.5 is going to be the true interest cost, the net true interest cost for a maintenance note. And then the 3.5 is the true interest cost for a PFC bond. When you take all the cost and the interest, that is the cost to the bondholder that they're going to receive and that we're going to end up paying to them. Then you have a couple of dates. So July is what we will hope is that the board approves the notice so that we can count 60 days from there until we're able to be able to sell the bonds. And then you have October, which is the date of the closing, potentially date of the closing. And then the last number is the 60 on the corner. It's a 60 days that we have to have as a public notice to the taxpayers, letting them know that this is a proposal before the market. So this is just a quick summary of the overall binder and presentation and everything that came about there. I have six questions, and I'm gonna go through them very quickly just so that in case I have to make sure I have them correctly. A question about renovation plan comparison, and Ms. Hinojosa, you asked that question, and so we'll follow up on that one. I don't know if you want us to answer this one, but I know we've already mentioned it. Phase 1 and phase 2 about being tiered. We had proposed that to being tiered, phase 1 and phase 2, but I heard some comments about putting them, both of them together. I don't know if that, how would you like us to provide any additional information about that?
So I would just want some feedback from you on these thoughts. I feel like this is a lot to approve all at once and a lot of projects to have. So all of these projects would be going in parallel. And so what I would like to see is some something that says from top to bottom, what are things that need to be addressed? It's an emergency. We're not able to function the way we are with these particular things. And so I'd like to see what are the emergency things that we definitely need to address right now? What are the things that are in the middle? Like, okay, we need to do it, but it can wait, but it still needs to be done. And what are the nice to haves that are included in this proposal? So when I was asking about if there's going to be a tiered approach, so I heard you now that you were asking for this to be approved by July. Is that what you said? That's right.
The July board meeting would be to approve the notice.
Right.
So that would be the first step. So you provide a notice to the market, you run the 60 days, and let's say that you want to continue, you go ahead and approve the bonds and you move forward. But let's say in 60 days you decide, no, I don't want to do that, I want to change it or what have you, then you still have the prerogative to do that as a board. But at least you run through the 60-day and then you determine that at the end.
Okay.
Otherwise, you have to start up again 60 days from that time.
Okay, so we still have some flexibility in moving forward with certain things or not moving forward with certain things. If we do this approval, the approval is just to set in motion the 60 days so we can. Right.
If it's going to go this way, then it'll have 60 days. If you change it, then you'd have to run another 60 days.
Okay.
So it'll push you down further, in the fall.
Okay. The other thought that I have are the other needs that we have right now, especially the new COVID-19 needs, the fact that we don't know what our school year is going to look like coming up, the fact that we don't know what our county is going to need from us so that they can have a productive school year and keep our students engaged. And then the conversation that we had 2 months ago about bringing our employees to a living wage. So these are some things that I would like to hear some more about. I mean, I think that this is a really great proposal, but I'd like to also see a proposal for those plans going forward as well on how we're preparing for that as well.
And just real quick, you'll hear some of that stuff on Friday when we do our budget workshop. That operating budget that we're going to talk about on Friday is different from this feasibility study where we're looking at taking money from fund balance. And so what you'll find on Friday that we've had built in, and we'll talk extensively about the $15 minimum wage for all employees and how that's been incorporated in there. But those are excellent points. I appreciate that.
Thank you. We have, yes, on Friday we'll address those two in specific, those two items. They're part of our presentation for Friday. The other thing that I heard from you was what is some information about the attributes of equine therapy in terms of how does that gonna parallel with AB East and AB West and High Point East, because right now we're utilizing equine services, but we don't have our own in terms of providing that to those schools. And so it'll be, I imagine that it would be parallel with the schools with equine therapy, but we'll provide some follow-up in terms of the details behind the equine project. You mentioned the deadline for fund balance, but I don't know whether we need to respond to that. I already mentioned to you that we don't have a deadline, so I'll just eliminate that one from the question that I have. And then the implications and the scope for adding the 4.5 million, Mr. Cantu, you mentioned that. What would be the comparison versus the market we were to do it now or versus later, and what would be the potential difference between, you know, and doing that, say now versus at a future date. So I have about 1, 2, 6 items that I need to follow up, and we'll prepare a report by the end of the week.
Well, I'd just like to say I thank all of our board members for joining us today and being patient with us. I know this was long, but you know, there's a lot to go over, and Friday's meeting will probably be about the same length. And the first meetings are normally the long ones, and then the second ones are a little bit shorter because we're polishing things. But I appreciate all the feedback, and Dr. Amesqua has done an exceptional job. Rich has done a very good job in working with LAN and helping to get some of this needs assessment. And it may not seem like it, but we've spent well over 100 hours just on this stuff. I mean, we've spent a lot of time and having meetings. We've been meeting about this, it seems like, what, since probably December, maybe before then. I don't know when we got LAN on board. But we felt like we were at the point now where we're ready to bring it to the committee. I was telling Mr. Cantu that it was initially what I was doing is planning for us to have a board retreat. I had already found someone to facilitate that, and we were going to bring LAN to actually speak to y'all about the facilities and bring you up to speed on what the facilities look like and why they felt that there was a priority with some of them. And then, you know, COVID-19 popped out. So, hopefully we'll be able to get back to that sometime soon. And once again, I'd like to thank Dr. Amesqua for the job that he's done in putting this all together. And by the way, we didn't do anything with the Legos, but I made with the parking garage right there.
Yeah.
And the front of the building.
Yeah, I included some of those. That was just, I asked the staff to take a look at and create a building and what their perception of a new building would look like. And I told them, okay, do it in a new adult ed center, do a hyponiche, what would it look like? And you see some of the differences in their perspective on how they reimagine those buildings to look like. So that was just to give you your input in terms of that, and then you'll probably have more input down the road. But yeah, this is just a startup.
My daughter was really happy with the Legos. And then after she took them apart, I was like, oh, was I supposed to see how that was like put out?
That's fine. Yeah, but just remember they're little, very small Legos, so be careful that because they're very tiny.
Got a lot.
All right, folks.
The other thing I'd like to ask is, I haven't seen, like, for example, I haven't seen the inside of the adult education building. So I'd like to maybe take a socially distant visit to go see it. And then, of course, I've seen the inside of our HCDE building, but I'd still like to go and see the issues that we have with storage and any of the other issues that you want to address for the renovation. And then the other thing, I was checking my notes, the other thing that I'm concerned about is how are we going to help our teachers in Harris County and our own teachers in our district pay for school supplies. When school's coming up, a lot of these teachers pay out of our pocket. I know that we've set aside some money to the Education Foundation, and maybe some of those grants would go towards things like that. But I just don't want that to get lost. So that's another thing that I'm concerned about.
So just know that I get a weekly update on the Education Foundation, and their applications, I believe, are due in the next week or two. And Ms. Bartz has been very diligent. I sent a text message out to 12 superintendents last week to remind them that their staff needs to apply for some of these grants. And we were just talking about this morning on the ELT that Aldine had called and wanted to know if they could write a grant for some of their contracting services. And so we spent an extensive amount of time talking about that, Ms. Bartz and I. So the requests are coming in, the need is there. I spoke to the Stafford superintendent last week who called me as soon as I texted him. And he was like falling out of his seat saying, this is perfect timing because I need this money. Tell me what I can spend it on. He was so concerned. He wanted to make sure that his grant made it through. He was just like, tell me what I need to say, Culver. Tell me what I need to put in there to make sure I get the money. And I'm like, you can put damn near anything in there and you're going to get it. So there's a lot of excitement, I think, going on with that right now because no one else is talking about actually awarding grant money and providing assistance right now. Everybody's kind of in a self-preservation mode. And so I think we're in a good place with that, especially for just getting started with that. So I'll try to keep you updated on that. Maybe what I'll do is, well, first of all, you can call me anytime and I can tell you. But I may also want to incorporate some of that into my superintendent report next month. And Amy, I'll get back with you about a tour. I need to figure out how we can do that in social distance at the same time because I'm used to throwing everybody in my car and us driving around, but I don't need all three of y'all breathing on me. I'm paranoid. Yeah.
So is this a completely new mechanism that we're talking about with the Education Foundation allowing the superintendents to have grants? Have y'all done something like that before or?
No one. Normally, it's their individual school districts foundations that supplement their general fund with money that they've gotten through philanthropic donations or whatever. But for us to do it countywide for 25 school districts, is unprecedented. Now,
how are we gonna? Sorry.
Go ahead.
How are we gonna be able to ensure that is able to go to the teachers to get them supplies? I don't know how that works.
Yeah, there's no guarantee that would happen. I mean, it's up to the districts to be able to ask for the money for that reason when they fill out the application. And I haven't looked at the applications that have come in yet and read exactly what they're requesting the money for. But yeah, the problem with Ms. Hinojosa's point is how do we find out what teachers need supplies? And then we'd have to be careful not to embarrass the districts in providing them supplies with teacher supplies when the district should be doing it for them. So it's a little political dance. We just need to be careful with that. Mm-hmm. I'm not saying it's impossible, but what I would prefer the district to do is request I want to write a grant so they could be able to provide supplies, let's say for their chemistry classes, or to pay for lab equipment or something like that. That's how it should work.
All right. Thanks.
Mm-hmm. Anything else? All right. Well, I appreciate y'all.
We'll see you on Friday.
We have to formally adjourn.
Yes, sir.
I just want to mention that on Wednesday, we're going to deliver some PowerPoint as well for Friday's meeting. So you'll get something like this again for Friday's meeting. So we'll have a deliver and we'll have another package, if you will, for Friday. Enjoy the goodies.
Thank you.
Motion to adjourn.
Second.
Motion second. Any opposed? All in favor? Meeting's adjourned. Thank you very much.
Bye.
Bye.
Have a good one.
Bye, guys.